Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. Money is money, and paper is paper. All the inventions of man cannot make them otherwise. Those words were written by Thomas Paine in an essay where he went after what he saw as one of the greatest scams in history: governments claiming that paper is money. It was a devastating critique, and Paine delivered one of the most brutal takedowns of paper money ever written. He systematically exposed every aspect of what he called a fundamental fraud. Paine started with the simple truth that cut through centuries of propaganda. Gold and silver are the emissions of nature. Paper is the emission of art. And he went on to explain that gold and silver have one of the qualities necessary for real money, because its value must come from a source outside of human control, making it stable and trustworthy. Paine wrote, "The value of gold and silver is ascertained by the quantity which nature has made in the earth. We cannot make that quantity more or less than it is, and therefore the value, being dependent upon the quantity, depends not on man. Man has no share in making gold or silver. All that his labors and ingenuity can accomplish is to collect it from the mine, refine it for use, and give it an impression or stamp it into a coin." Paper, Paine argued, fails as money because it lacks this quality, among other qualities. He wrote, "Paper, considered as a material whereof to make money, has none of the requisite qualities in it. It is too plentiful and too easy to come at. It can be had anywhere and for a trifle." Now, unfortunately, the powers that be did not listen to Thomas Paine. Or maybe they did, and they realized that the dream of big government is impossible with sound money. Governments need to be able to print money at will to support borrowing and spending. A big welfare state, a big warfare state requires money printing. In a fiat system, the government can levy the inflation tax on the people. And since most people don't notice inflation, at least not immediately or unless it gets too bad, it's a lot easier for government to get away with taxing them, right? They're not noticing it. It's not like the tax collectors coming and banging on their door. They're just stealing the value of their money. So gold and silver are sound money. You should read that essay. I'll link to it on the show notes page. It's a really good explanation from Thomas Paine about why paper fails as money. But gold and silver, money. But unfortunately, people out there in the investment world, they didn't pay any attention to Thomas Paine either. And they have turned the gold and silver markets into a paper market. Now, it's not exactly the same as fiat, but the impacts are very similar, and we're seeing this manifest in the silver market today. So what I want to talk about today is I want to delve a little bit into the paper silver market versus the physical silver market. But first, I do want to thank you for listening to the show. As always, I really, really appreciate it. Appreciate a couple of folks who reached out and hoped I was feeling better after trying to do the podcast with a bad cold last week. I appreciate that. I feel much better. I think you can probably tell from my voice. Not 100%, but definitely better than I was. So anyway, I do appreciate you listening to the show. And as always, would really appreciate it if you would share these episodes and write a good review for us. Give us those thumbs up wherever you're listening to the show. That will help grow the show and spread the word. And if you're getting some value out of it, maybe other folks will as well. So again, thank you. I do appreciate it. And, while we're on the subject of silver, I do want to call your attention to the fact that we do still have junk silver at below spot price. And when I say junk silver, I'm talking about quarters, dimes, half dollars that were minted prior to 1965. These quarters, dimes, half dollars, they're 90% silver. So the melt value is worth way more than a quarter. And we still have junk silver on sale at below spot price. It's a great way to invest in silver if it's something that you're thinking about doing. And I think now's a good time, right? We've had this correction in the silver price. We're trading below $80 an ounce. And I think that we still have a lot of upside for reasons that we're going to discuss today in the show. So keep that in mind, and remember that we do still have junk silver at below spot, and we have some other specials as well. If you just go to moneymetals.com and you click on that specials tab, you'll see the bargains that are available. So let's talk about the silver market. Paper silver has basically driven the market for years, but with metal in short supply, physical demand is starting to exert control over the market. So what do I mean by paper silver? I'm talking about the futures market, right? People have contracts. The contract is basically for, say, 30 days. And in that contract, it says, we're going to deliver X amount of silver at this price at some point in the future. So it's a futures contract, it's paper. And the problem is there are a lot more of these future contracts out there than there is actual metal. So, you kind of have, 4 paper contracts and 1 silver bar, and they're all kind of laying claim to that silver bar. Now, the idea is that not everybody's going to want to take delivery, so it'll be fine. And generally it is fine, but it has become much less fine over the last few months, as we're going to discuss. So I'm sure that folks that are listening to this show are pretty savvy on what silver has done, but let's recap. After briefly skyrocketing to $120 an ounce in January, the silver price has corrected and it's retreated to the $75 range, and I think it's around $77 today. We're up. We're still seeing a lot of volatility in both the gold and silver markets, with big price swings as people kind of try to figure out what's going on after that big correction. But running between $75 and $80. However, even with the correction, one of the fundamentals driving silver to that record high remains in place. And that's the simple fact, and I've hammered on this in the show, I've hammered on this in the writing, there simply isn't enough physical metal to meet all of the demand. And analyst David Morgan, he's the publisher of the Morgan Report, and I've interviewed him several times for our podcast recently, just a couple of weeks ago, and I'll link to that interview on the show notes page. David Morgan's fantastic analyst. He is a macro analyst, so he's looking at the big picture. And he was recently interviewed by Kitco News, and he said some really interesting things that I'm going to kind of use to tie this discussion of the silver market together. And what he said is that physical demand is beginning to exert dominance over paper-based pricing mechanisms. Now, let's talk a little bit about this paper-based pricing mechanism. I gave you the quick overview. Just how much more paper is there than actual silver? Well, according to analyst Faisal Amin, or probably Amin, and this was published by FX Street a while back, the paper to physical ratio is somewhere near 356 to 1. So in other words, for every ounce of physical silver in the world, there are 356 paper ounces. So a lot more paper out there. And when you look at the mechanism, it's really no different than fractional reserve banking, right? So in fractional reserve banking, a bank doesn't have to have $100 to loan out $100. It only has to have $10, right? It only has to have a fraction of what it's loaning out in reserve. So again, as long as everybody is content to keep their money in the bank, the system hums along quietly. But when people lose faith in the bank and they demand their dollars, you end up with bank runs. So similarly, when people demand delivery of physical silver, the paper system gets shaky. And ultimately, if enough people want to take delivery of that physical silver, well, then the whole system's going to collapse, right? Because there are a lot more people with the paper making demands to have their silver than there is actual silver to fulfill all of that demand. As Amin put it, quote, silver prices are not just reacting to demand right now. They are reacting to the realization that the market's underlying structure is no longer credible. So, looking at the official COMEX depository data, and this is as of February 11th, and just to to be clear, the COMEX is kind of the center of the futures trading, particularly in the West. So you have various centers of the silver market. You've got New York, you've got the COMEX, you've got London, and you've got Shanghai. And so looking at the COMEX depository data, and again, this is where a lot of the futures trading is centered. Total registered silver stocks have dropped below 100 million ounces to 98,138,005 ounces. So dropping below that 100 million threshold is pretty significant. Now, what do I mean by registered silver? Well, registered silver simply is what is officially available for delivery against a futures contract. So in a COMEX vault, you will have both registered and eligible silver. And eligible is silver that is owned by ETFs and other financial institutions that's being stored in the vault, but it is not available for delivery. And interestingly, an additional 4.7 million ounces were actually withdrawn from the eligible category based on the last COMEX report, which tells you that people are trying to let go of that silver and making it available for delivery because there's so much physical demand. So David Morgan told Kitco News that this drawdown in COMEX holding indicates that the global silver market is under stress. He said, quote, "The physical market is taking control over whatever the paper price is." And where we're really seeing this physical demand is in Asia, both from investment and industrial demand. Keep in mind, a lot of the electronics, the solar energy production, a lot of that is based in China and in India. So we're seeing this really strong physical demand in the East. And this is exacerbating the displacement of metal. And we see this in the silver benchmark price in Shanghai, which is currently running a premium of around $10 an ounce over the Western spot price. So in other words, that silver benchmark price in China is $10 higher. That's telling you that there's not enough silver in that area. So the premium's higher, and the idea is that the arbitrage opportunity will draw silver out of the West towards those Asian markets. But there's not a lot of silver to move because silver supplies in London have been tight for months. And, this started last spring, so almost a year ago now, when tariff worries incentivized the movement of silver out of London vaults to the U.S. And this was all due to worries about the tariffs. An explosion in Indian silver demand this fall was kind of the straw that broke the camel's back. And it led to the first round of what I call the silver squeeze, and that pushed prices above $50 an ounce for the first time ever. And initially, as Indian demand spiked, buyers were primarily sourcing their silver from Hong Kong, but they reportedly shifted more toward London during the Chinese Golden Week holiday in the first week of October. And at that point, London vaults were already tapped out. So prices skyrocketed. Silver moved from New York to London, and that eased some of the pressure. But the problem fundamentally cannot be solved by shuffling metal from one place to another, right? Because we have that fundamental problem. There simply isn't enough silver. So while the COMEX is primarily centered on the futures market, the Shanghai market is more oriented towards industrial users. As David Morgan put it, quote, "It's certainly a futures market, but not to the extent London and New York are, which means a lot of that silver that's in inventory or on exchange is going to be taken by somebody for purposes of either investment or industry." And of course, this drain of silver out of Shanghai vaults is creating tight supplies. And the price difference, as I've already mentioned, should incentivize a flow of metal from the West to the East. However, Morgan said that logistics and capital controls are creating friction in the market. And he said, obviously, if you're willing to pay more than the benchmark price in New York, it's going to be flown over to China. But the spread hasn't closed. Something's up. And I think that something is that there just isn't enough metal in London to facilitate that movement, right? You add on top of that the logistics and the capital controls that Morgan already mentioned. Well, you have a very tight, sticky market. And Morgan pointed out that this big demand for physical metal in China is requiring 1,000-ounce bars, which is typically the domain of the COMEX. These are commercial bars, and they're generally what is used in a futures contract. And Morgan likened retail demand to a flea on a dog compared to the tail on a dog. He said, quote, once the industrial needs were not met, you saw that the physical market took over the silver price. That has happened very sporadically in the past. This time, it was the real deal. We saw something that we haven't seen in a long time. We saw the silver price in 2025 go up 140%. And then we saw a 70% increase in a single month in January. Now, I kind of want to go back to this idea of the 1,000-ounce bars, because I think it's interesting. Money Metals had a bunch of 1,000-ounce silver bars in the vault, and I actually saw them when I was in Idaho a while back at our facility. And it's pretty cool. 1,000-ounce silver bars, like a pallet of them was worth well over $1 million. And this was before the big jump in silver price. And we actually sent some of those 1,000-ounce bars to India. So this just kind of reiterates, we're a retail company. We're not typically involved in these big futures trading and whatnot. But there was so much demand that we did send several pallets of 1,000-ounce bars over to India. So that just goes to show how strong the physical silver demand has been. Morgan emphasized that, fundamentally the silver market is still a derivatives market, is still a futures market. And what happened is it's gotten significantly overextended over the last several months. Quote, the paper price, the paper paradigm took over. So temporarily, even though the 1,000-ounce bar market had basically taken control for weeks, perhaps months, and everybody was kind of cheering that who understood what was really happening, it didn't negate what was going on in the futures exchanges around the world. They go ahead of themselves. And Morgan said that kind of eventually brought things back to reality. We saw the price correction. We're back down to, $75, $80 an ounce, and that's where we are today. And I think Morgan really sums it up. Now we are in a struggle between who's going to win at this point. And it could go back and forth for a couple of more times. Is it the paper pushers or is it the physical demand? So, I'm of the opinion that eventually in a system like this, physical demand wins, right? How much silver is there? That is the absolute key. So we're seeing all of this demand for physical silver in the Shanghai market. I've already mentioned the fact that there's a lot of demand in India as well, and this is adding to that demand pressure. And we're talking both investment and industrial demand in India. And investment demand has really grown over the last several months. And I think a lot of that is because the price of gold has gotten so high. And a lot of poorer folks in rural areas are turning to silver because it's more affordable. They can still preserve and protect their wealth, but they can't afford to get into gold, so they're turning to silver. So we're really seeing this boom in demand in India. Then we can add another thing to the mix. We have policies at the COMEX that are kind of altering the market. The CME Group recently raised margin requirements, meaning that traders have to put up more upfront money when entering into a futures contract. And Morgan said, quote, the higher margin goes, the more we're forcing a cash-only market. Adding that higher margin requirements create a natural break on speculative rallies by flushing out highly leveraged traders. So that's probably a little bit more of what we've seen underlying the recent correction, right? These highly leveraged futures traders are taking advantage of the lower price to get out of their shorts. And again, this is adding even more pressure in the market. Now, all of this is playing out in an environment where physical silver demand is outstripping mining and recycling supply year after year. Based on preliminary data compiled by the Silver Institute, silver demand outstripped supply by about 95 million ounces last year. It was the fifth straight market deficit. So when we put those 5 years together, the total deficit was above 800 million ounces. That's an entire year of silver mine output. And the Silver Institute projects the sixth market deficit will be this year of around 67 million ounces. That's even with higher prices creating headwinds for industrial demand. So with the supply of metal limited, this battle between the paper and physical markets is likely going to continue. That means you can expect more price volatility. Don't be surprised if you see big daily swings both up and down as these markets kind of wrestle with each other. But I think as you watch the market progress and as you think about the midterm or the longer term, it's important to keep in mind one crucial fact. They can create paper to their heart's content. They cannot create metal. And just like sound money will always win over fiat in the end, I believe the physical market will eventually overpower the paper pushers. Metal, the market is about the metal, right? How much metal is there? That's the thing that I think it's important to keep your focus on. So that's the silver market. I suppose before we wrap up the show, I probably should mention the CPI report that came out last Friday. Although honestly, when I talk about inflation, I feel like a broken record because everything that I say is so counter to what you hear in the mainstream news. But alas, I think it is one of the most important factors to consider if you're a gold or silver investor, right? Inflation is fundamentally about your money. And your money is broken, right? That's what Thomas Paine was writing about. Go back and read that essay if you get time. It's worth reading because this is exactly what he was talking about. So we have this inflationary environment. Gold and silver are an inflation hedge. So it's very important, I think, to look at inflation and monetary policy and what the Fed is doing because it has an oversized impact on the economy. So let me just put it succinctly, just because prices aren't rising as fast as they were a year ago doesn't mean that inflation is dead and gone. Now, of course, if you listen to the financial media reporting on the January CPI, you're going to get the impression that the Fed has slain inflation. It was a great report, great news. I read one reporter, I think she was on CNBC, and she was talking about how this is going to be a boost for the middle class because they're not having to, fight these rising prices. So, yeah, the Fed's won, right? No, it hasn't. Okay, so let's look at the numbers real quick. The headline annual CPI fell to 2.4%, and that is getting close to the mythical 2% target. Yay for them, right? But think about it. The goal is to steal 2% of your purchasing power every single year. That's more than 10% of the value of your dollar eroding every 5 years. That's the plan, right? That's what they're shooting for. Right now, we're above that, so it's worse than that. But what they're shooting for is still inflation. The bottom line is there is always inflation. And there is more inflation than that CPI data reveals. The CPI is not really a very good way to gauge inflation, to be quite honest. It's the money supply, and the money supply is at record levels, and it's rising. This is, by definition, inflation. So remember, and I hammer this point over and over again, and I'm going to hammer it as long as I've got a voice and a microphone. Technically speaking, inflation is an increase in the supply of money and credit. That used to be what they meant when they said inflation. Rising consumer prices, measured by the CPI and other metrics, are just one symptom of monetary inflation. Monetary inflation can manifest in other places. It doesn't necessarily show up in consumer prices. In fact, it usually doesn't show up in consumer prices first. It usually shows up in assets like the stock market or real estate because the first people who get this newly created money are the bankers, right? So it makes sense that banking kind of things, these assets are going to pump up first. So we see this inflation in the stock market. We see it in real estate. We see it in art. We see it in all kinds of things. And it can also show up in consumer prices. And really, what else is going on in the economy, other policies can really dictate how that inflation manifests. But here's the thing, inflation is always bad, right? Just because it's not showing up in consumer prices doesn't mean it's okay. So when you hear the CPI report, you probably should take it something like a thermometer, right? It can tell you if you have a fever, but it can't tell you what's causing it. Now, if you listen to the politicos and the pundits, you might think that tariffs cause inflation. Or maybe it's greedy corporations. Perhaps it's Putin's fault. Remember Putin's price hikes? Or, maybe it's just unicorns waving magic wands and that causes prices to go up. Wrong, 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 and wrong. It's the money printing, stupid. Right? Inflation is an increase of the supply of money and credit. And who incentivizes the increase in the supply of money and credit? It's the Federal Reserve through literal money printing when they operate quantitative easing, or indirectly by cutting interest rates, making interest rates artificially low, and increasing the money supply via bank lending. So as the Federal Reserve revs up the money-creating machine even higher with rate cuts and stealth quantitative easing, the money supply is already growing at the fastest rates since July 2022, which was the early stages of the Fed tightening cycle. After peaking in April of 2022, the money supply actually began to decline as the Fed hiked rates that year. And they also began shedding some of the assets from its balance sheet. So we had quantitative tightening and rate cuts. And so the money supply dropped. It was sucking liquidity out of the system, which is exactly what it's supposed to do. And the money supply bottomed in October 2023, and then it began increasing again. So we've had inflation since 2023. Now it's accelerating, and it is well above the pandemic peak. So, as I've already alluded to, we also know inflationary pressures are increasing because the Federal Reserve is once again expanding its balance sheet through quantitative easing. Now, you're never going to hear anybody at the Fed utter the term, right? But the central bank did relaunch QE back in December. So that means they are once again buying U.S. Treasuries using money created out of thin air. Again, this is by definition inflation. How's it going to manifest? Is it going to manifest in asset prices in a skyrocketing stock market, or real estate inflation, or consumer prices? Hard to tell, but there is inflation. So my point is, there is still plenty of inflation. That means you need to hold real money to protect your wealth. You need gold and silver because money is money and paper is paper. Right? So now, if this is your first time listening to the show, you might be asking yourself, well, Mike, why are people still screaming for interest rate cuts and looser monetary policy if inflation is on the rise? Why would the Fed do that? Well, because, as I've been saying for months, the Fed is in a catch-22, right? It needs to cut interest rates and run quantitative easing to support the debt-riddled bubble economy. You got to feed the debt black hole. But the economy also needs higher rates to keep price inflation under control. Obviously, the Fed can't do both. It has to choose. It is choosing inflation. Any cooler than expected CPI report will throw more fuel on the easing fire and raise the possibility for more rate cuts this year, despite the central bankers' efforts to tamp down expectations for future easing. So in other words, you get more inflation despite what the CPI data might indicate. Okay, I've got one more question for you before we wrap up the show. Would you take investment advice from a 10-year-old girl? Now, you probably reflexively answered, no. Well, maybe you should reconsider that answer. One little girl in China sets the intelligence bar pretty high. In fact, people are calling her a genius based on her investment savvy. 3 years ago, so when she was 7, She started buying gold with her Lunar New Year lucky money. So let me give you a little context. On the Chinese Lunar New Year, which was actually yesterday, February 17th, Chinese adults traditionally give children with red envelopes containing, quote, lucky money. I have the Chinese words here. I'm not going to try. So the girl's mother, I think you pronounce it Bai, said that the young lady receives about 4,000 yuan each year. So that's about $580 at the current exchange rate. So that's a pretty good little chunk of cash every year for a 7, 8, 9-year-old girl. Bai said the little girl started investing her lucky money in gold because she was worried that her parents might get the money and spend it. So, revealing wisdom way beyond her years, the girl expressed belief that gold is easier to preserve than cash. Now, she was worried about her parents taking her money, but, big picture, she's absolutely right? One of the reasons to hold gold is its role as a safe haven and as a secure way to store your wealth. You got to be pretty impressed with this young lady's perceptiveness. Now, of course, it's highly unlikely that this little girl understands that the government is more of a threat to her lucky money than her parents. The Chinese is as fond of monetary manipulation and currency devaluations as its counterparts in the West. And as fiat currency loses purchasing power, the price of gold rises. Now, she might not be able to articulate this. She probably can't. But she learned this lesson in economics through experience. When she first bought her gold, it was around 460 yuan per gram. By this past February, the value of her gold had surged to $1,100 yuan. That's a 139% return on her investment. Most financial planners would kill for that kind of return. Bai said that her daughter has accumulated around 30 grams of gold. It's interesting because in China, 1 gram gold beans are very popular. They're affordable. So a lot of folks will buy these little 1 gram beans and you'll see jars holding these gold beans. And so she's got around 30 grams. Her mom said she hasn't sold any of it, not even when prices plunged during the correction in late January. In fact, her mom said this little girl plans to buy more gold. So like I said, might not be a bad idea to take investment advice from a 10-year-old girl, at least this particular 10-year-old girl. And if you're thinking, you know what? I need to get some gold because I know the government is devaluing my money every single day, and it is. I need silver. I need gold to protect and preserve my wealth. You can do it. Call 800-800-1865. Talk to a Money Metals, Precious Metals specialist today. If you have questions, if you want to know how, when, what, they can answer those questions for you. These folks are fantastic. They're knowledgeable. They love talking about gold and silver. They'll help you figure out how you can fit precious metals into your investment strategy and on your budget. Now, if you don't want to talk on the phone, you don't have to. You can go to moneymetals.com and chat with a precious metals specialist online. Or if you know what you want, and I would advise this because we're still getting pretty high call volume, you can just go to moneymetals.com and purchase the things that you want to purchase. You want to get some, gold eagles? Well, you can just search for those. You can find them on the website, order them. We'll package them up, we'll ship them out to you, or we can store your metals in our state-of-the-art bullion depository. But act now. We've had a correction. We've got gold trading a little bit below $5,000 an ounce. We have silver below $80 an ounce. I think these are buying opportunities. I've talked about ad nauseum why I think that we're in a long-term gold market and we shouldn't be scared off by these corrections. So I view price drops as a buying opportunity. So you want to act, strike while the iron's hot, as the sayings go. So do it today, 800-800-1865, moneymetals.com. So that is a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything I've talked about on the show today and a whole lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, Join 1 million other people and sign up and get on our email list. Now, of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you'll also access our Market Wrap podcast that runs every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world in gold and silver. This week, I'll be talking with Axel Merck, who's a very interesting analyst. So check it out. Thank you so much for listening to the show. As always, I appreciate it. I know there's a lot of stuff out there that you can be listening to, and thank you for choosing to spend a little bit of time with me. That is a wrap for this episode. I will be back again behind this microphone next week.